We're going to move to this, what I call equation analysis. It's the analysis of the accounting equation. We're going to use this to analyze transactions. What we're going to be doing, and by the way, I'm going to push the homework back. I know we're not going to finish 2 today, but what we're going to be doing is looking at the accounting equation that's expanded. They call it a financial statement effects template. And this will tie in all of the financial statements to every transaction. I'm going to probably use this for a good part of the course, in fact, almost the whole course, where we start the accounting cycle. Accounting cycle starts with a transaction, then it has to be analyzed, journalized, and posted. So this is going to be, at this part of the process of the cycle, will be, our objective is to analyze transactions before we actually record them, to analyze their effects on the equation. So again, we analyze, journalize, post, and then ultimately build a financial statement. So we're starting with the balance sheet. So let's take a look at this equation, the way it is set up. Now, a lot of you know that this is a double entry system. You only affect 2 or more accounts. You don't affect all these accounts at the same time. Well, what we're going to be doing, for example, you're not going to see it here until we get to the income statement, but anytime there's a revenue, you should realize that, let's say it's a cash sale, it'll affect the asset cash, it'll increase revenues, but revenues also increase what? Retained earnings, unearned capital. So you have to see the picture simultaneously. It's a real-time event. Now, when we book this transaction, it'll only affect cash and revenue, but it will affect retained earnings as well. Now, we have to be very careful because I had a student that would always tell me, I have a sale of merchandise. I'm going to increase cash and I'm going to increase retained earnings under earned capital. Technically, the student is right. Technically. But that's only after the cycle is completed. To record the transaction, you have to record it through sales first. So there are some details that have to be provided before you could actually get it to retained earnings. So let's go through the accounts. And each account on the balance sheet and income statement when we get there is really a device to record income and expenses, assets and liabilities, and changes in those accounts. A chart of accounts, by the way, just so you're clear, a chart of accounts is something that you're going to see in an accounting information system, so that if you look at your client, account 1010 could be cash, 1020 could be accounts receivable. So these are the account numbers that are assigned to asset liability and stockholders' equity accounts. Chart of accounts has nothing to do with the debits and credits, has nothing to do with the accounting. It is absolutely a reference system. It's a reference system for you. Now, the accounts, of course, in the transaction analysis, usually we have a double entry system. At least 2 accounts are affected. When we go through this transaction analysis and the equation, we're going to look at the fact that the balance sheet has to balance. And we also have to worry about the effects, whether it's increasing or decreasing, and we have to look at the dollar amounts. So let's take some transactions. Now we're going to start playing with numbers. So you've got, on May 1st, investors contributed $10,000 in cash to start a business, Jana Juice, which sells energy drinks to retailers and individuals in exchange for 500 shares of stock. When we look at the equation, we're going to see that cash comes in, so we increase the asset cash, and we're also going to increase the contributed capital common stock account. So the cash account goes up, and so does the common stock account. There's no revenue there. This is a transaction that's purely an equity transaction. It increases assets and equity, and the balance sheet balances. When we look at the statement of cash flows, which we didn't yet, we just went through some of the categories. Is this an operating activity, an investing, or a financing activity? What do you think? Financing. Financing. The people that are on the other side of this are investing, but you're getting the cash, so you're basically getting the financing. So that's a financing activity. So both cash and common stock increase. Next, transaction number 2. They borrowed $4,000 by signing a note on May 1st, but they have to repay interest of 40 as well as principal on May 31st. So the only transaction we're worried about here is May 1st. And you borrow. In this case, cash comes in at $4,000 and liabilities increase. No change in revenues and expenses, no changes in equity. And this again is what kind of transaction? Operating, investing, or financing? It's financing. You're financing your operations by issuing common stock of $10,000 and debt of $4,000. And the balance sheet still balances. Now, of course, if I'm going to build this up later, but right now, you've got cash that's building up, and I have a liability. So both cash and your liabilities increase. Okay, another transaction. They sign rent. They sign a rental agreement for a store, and they paid $1,800 as a security deposit. That's like a prepayment in a sense. So when we look at this, we've got a non-cash asset, the security deposit. That is an asset. Why is that an asset? It's got future benefit. You might want to consider it a prepaid rent. It's also something you're going to get back, right? So it's not necessarily an expense at this point. It gives you future benefit, and cash is spent. Now notice you change the composition of the assets, but not the total. So what you've done in the asset section is you've taken a non-productive asset, cash, and stored it to create productive assets. You need the rent deposit to occupy the office in order to sell or the store. Now, one of the things I'm going to ask you here is what type of activity from the cash flow side? Is that an operating, investing, or financing activity? Operating. It's an operating activity. So whether you know it or not, by answering these questions, you're starting to build the financial statements. Even though the cycle takes a long time, with all the debits and credits and the closing and the transfers and all that, basically this is where you're going to wind up. You're going to wind up with a balance sheet and a cash flow statement right now. There's no income statement because we haven't affected any expenses or revenues. And there's your effect. Okay, next. We buy inventory on account. Now, people say on account of what? No, it's on account, meaning it's accounts payable. It's a liability. Inventory is accounts payable. Now, for the most part, inventory purchases will be paid through accounts payable. And this is an open line of credit. It's trade credit that you have. It's you make a phone call, or you send an email, or you send even a text message to your supplier and say, could you just think about the last time you brought your car in for service at a local gas station, right? You're sitting there and I call somebody up, listen, I need a muffler for a 2014 Toyota, right? Brings it right over. In 2 hours they have it. That's an open line. You don't have to sign anything. The person that brings that muffler over to the repair shop is not looking for you to sign any documents. It's open trade credit. It's an open trade credit. So that when you put this on your balance sheet, your non-cash asset inventory increases and your accounts payable increase. And again, you are in balance on that balance sheet. So for us, for the most part, unless you hear otherwise, the inventory purchases will typically be accompanied by accounts payable unless you pay for those in cash. Now, what I decided to do, we don't have any revenues and expenses right now, but what I decided to do was just take a subtotal or a summary, and the book doesn't do this. I actually made this one. I was able to make this one myself out of the PowerPoint. But you notice that a cash account right now has $12,200. Right, so there's $12,200 in cash. The non-cash assets are $38,000. Your liabilities are $6,000, and your equity is $10,000. So the balance sheet is in balance right now at $16,000. The balance sheet is in balance at $16,000. And if I had to use this, by the way, we will use the equation for analysis purposes, but as a recording device, you can imagine that this would become extremely cumbersome. I mean, this is not my information system. This is not the way I'm going to be recording transactions. But if it was my only device, this is the way my balance sheet would look. I'd be able to take the transactions that I analyzed, I recorded them on the equation, I summarize the equation, and now I build the financial statements. So the assets, we have cash of 12.2, inventory of 2,000, security deposit of 1,008, and notice that those are in the order of liquidity because cash is much easier to sell. How are you going to sell the security deposit? Or like the prepaid rent? You can't unless you ask the owner of the building if you can transfer that to somebody else. It's not as easy as selling the inventory. On the liability side, order of maturity, current first, accounts payable, and then the notes payable or the non-current. Stockholders' equity, all we have is common stock. We had no excess over par value. In fact, I had a pretty good question about what if you sold stock below par? Doesn't happen much, but if it was, the discount would be negative equity. The discount or the others. All right, so that is our first step in looking at transaction analysis. So I analyze the transaction, I'm recording it in the accounts on the equation for now, and then I use the summary to build the financial statements. Any questions? I'm going to go as slow as I possibly can because these are the beginnings of the fundamentals that we have to